Welcome back to class, and this is the second module of the course Macroeconomics, and we'll be discussing national income accounting in this module. And I want you to listen attentively as we go on to look into it. And in this module, we'll actually explore how economists have use various indicators such as the gross domestic product, the gross national product, the net national product, to capture the economic pulse of a nation. And by this, we have an opportunity to measure um, to look into measures that provide essential insight into the size, the health, and direction of the economy. Also, we'll explore the three main methods of calculating the national income output, the income and the expenditure approach, each offering a unique lens through which we are able to view the economy. And lastly, we will consider the challenges and criticism of GDP as a comprehensive measure of well-being. And these are the things we will look into. When we talk about economic indicators, what, what are the economic indicators? Just like I said in the introduction, the economic introductions and indicators that are recognized by economists are the GDP, the GNP, the NNP, and more. And this captures a nation's economic pulse. And the measure, this measure provides essential insights, just like I said, into the size, the health, and direction of the economy, and serves as a key tool for government planning, the international comparison, and economic forecasting. In a way to just give a brief of what this term means, because we'll talk about it more. Gross domestic product is the total value of goods and services produced within a country's border. And for the GNP, it's actually the total value of goods and services produced by a country's nationals, regardless of the location where they are. And the net national product, which is the NNP, is the GNP minus the depreciation, which reflects the net productivity capacity of an economy. Elaborating on the GDP, just like I said, it is a total monetary value of all finance, goods, and services produced within a country's geographical boundary during a specific time period, and it reflects the scale and health of an economy widely used by governments, policymakers, and investors. What are the key points we need to look into or we need to understand when we talk about GDP? The first one is that the only the final goods are the only one. The final goods and services are the ones that are only counted. Also, it includes only domestic production, and also it measures the current production, and lastly it excludes the non-market and illegal activities. And these are the key points of GDP. And we have the types of GDP also. We have the nominal GDP and the real GDP. I will talk about the nominal GDP. It measures it is used to measure at current market price and adjusted for inflation. And for the real GDP, it's adjusted for inflation, reflecting actual quantity of goods and services. We have method of calculating the GDP, and this can be seen in three ways, which is the expenditure method, the income method, and the output method. And in theory, all these three yield the same results, offering unique lenses to view the economy. For the expenditure method, this is GDP is equal to the consumption plus the investments plus government spending plus the net exports. And when we look at the next exports, it's the X minus M, and that's the net exports. And for income method, it is GDP is calculated as wages plus rent plus interest plus profit plus indirect taxes minus subsidies. And for the output method or the product method, this GDP is calculated as gross output minus intermediate consumptions. Looking at the calculation, GDP is useful for measuring how fast an economy is growing and the average income per person. In order to do this, we have the concept of the GDP growth rate and the GDP per capita. When we talk about the GDP growth rate, it's actually the real GDP, which is the current year, minus the real GDP of the previous year, um, divided by the real GDP for the previous year multiplied by 100. And for example, if we have a real GDP in 2023 to be 95 trillion naira, and also for 2024, we have 100 trillion naira. In order to know the GDP growth rate, we just using the formula, you see that we are able to get 5.26%, which is the GDP growth rate. And as such, we know the exact rate at which the GDP grows from from year 2023 to year 2024. And for the GDP per capita, it's calculated by dividing the GDP over population. And for example, if the GDP is 100 trillion naira and we have a population just like of Nigeria above 200, but in the example we have 200 million as a population, then you can calculate the GDP to be 500,000 naira. And this means that average income per person is 500,000 naira per year. For the gross national product, which is GNP, it measures the total monetary value of all final goods and services produced by nationals of a country within a specific period, regardless of where the production occurs. And the emphasis is on the ownership of production. And to calculate this, it is GDP plus net factor income from abroad. And when we talk about net factor income from abroad, it is the difference between income earned by nationals from abroad and income earned by foreigners within the country. And when you have a positive NFIA, the GNP increases above GDP. And while there is, when there is negative NFIA, you have the GNP less than the GDP. And for example, if Nigeria's GDP is 43 trillion naira and the national earns 2 trillion abroad and foreigner earns 3 trillion domestically, then if we will know the NFIA, it means that we will deduct that's 2 trillion minus 3 trillion. That gives us a negative, and that will actually reduce our GNP. And so we will see that the GNP is less than the GDP as such. So the next is the net national product. And when we talk about the net national product, it's built upon the GNP by accounting for the depreciation, that is the wear and tear of capital assets, and making it a more refined indicator of a country's net productive capital. And to calculate the NNP, we use GNP minus depreciation. And just like I said, depreciation represents the reduction in the value of physical capital due to use or obsolescence And NNP reflects the actual income a nation has available for consumption and investment after maintaining the capital stock. And what is the significance of the economic significance of NNP? It is a more accurate reflection of sustainable income, and it is crucial for long-term economic planning and assessing economic sustainability. And an increase in the NNP signals sustainable growth. Just like I gave a short understanding of the real and nominal GDP, um, the nominal GDP is also known as the current price GDP or the normal money GDP. And it is the total market value of all final goods and services produced in a country within a given period. And it measures using measured using current price of that same period. And it does not adjust for changes in the price level or inflation. And to calculate this, we say its nominal GDP is equal to current price multiplied by quantity of goods and services. And that's how to calculate the nominal GDP. For the real GDP, it measures the value of all final goods and services produced in a country within a specific period, but it is adjusted for inflation, and it uses constant price from a base year to eliminate the effect of price change, allowing economists to measure the true growth in the quantity of goods and services produced. And the formula to calculate this is real GDP is equal to base year price multiplied by the quantity of goods and services. So real GDP is crucial for assessing economic growth, answering if the country economy is producing more and more goods and service, or if prices are just higher in that regard. What are the limitations of GDP as a measure of welfare? Um, while it tracks economic growth, it has significant limitation as a measure of overall welfare or societal well-being, and these include the exclusion of non-market activities, that is, it ignores unpaid household works, the subsistence farming and volunteer services, and also it ignores income distribution, that is, it does not show how income is distributed, masking inequality. Also, it fails to account for environmental degradation, and this includes production at the cost of environmental damages without deduction. It also includes negative externalities. Um, it counts spendings on disaster recovery or pollution-related illnesses as possible output. And lastly, it omits informal and shadow economics, and that this means that it does not capture unregistered transactions underestimating actual welfare. In conclusion, national income accounting provides essential tools for measuring economic performances with GDP, the GNP, and the NNP, offering insights into production, income, and expenditure. And what you need to know is that beyond GDP alone cannot fully access welfare. And policymakers advocate for complementary indicators like that of the Human Development Index for more comprehensive evaluation of societal well-being. Thank you.